When you look at a broad view of the statistics, you start to piece together the bigger picture. Things aren't the way they seem from the outside. When you skim over the top, when you just read the headlines, when you ignore reality, you can claim ignorance is bliss, but it will hurt your ego when you realize you are hanging off the edge of the cliff. Or simply, just wake up. You came here for the truth, so let me unveil that for you. Today we are going to look at a report out of DoubleLine. They produced this excellent report. I went through it and I thought to myself, I have to make a video about this specifically because it's so good. There's so many charts in here that tell so much of the story, so I wanted to bring that to you. So stay tuned. I got a jam-packed episode. Let's begin by taking a look at this. The red line is the S&P 500. The blue line is the emerging market index, and this is normalized as of January 26th, 2018, and you are looking at what happened. Now, this connects into the chart I'm going to show you in a moment, but for now, we're looking at this, comparing the two, where we see through 2016, 2017, both of these had rocketed higher. There's no doubt about that. Emerging markets and US stocks all went higher, particularly in 2017. It seemed like it was a straight line upward. Then we had the VIX issue, okay? This moment here changed everything because all markets began to fall. And that's the central theme of this video, so stay with me on this. But the S&P 500, the NASDAQ, and the Dow Jones started to rise further. And we saw in particular the tech shares rising to new highs. Most of them were able to do so. We saw the markets really chasing in, and money was flooding in from all around the world into these tech shares primarily. But the emerging markets, they continued to fall. And of course, they weren't the only ones. I'll show you more in a moment. But this basically just tells us the divergence that was seen at this moment in time. You can see the difference in between these two. In September was really where it started to get very exaggerated. But then we had a little issue. At the beginning of October, everything fell together. Everything. You could look at basically any asset and it was falling in October. But they said, don't worry, it's the share buybacks. That's the problem. So as soon as November happens, we're gonna see this take off. There were countless analysts, probably close to 100% of analysts were saying November, we're going to see an uptick in the market. So don't worry, now's the time to buy in. November was terrible. Then December came and they said, don't worry, because December is always a good month. So now is the time to buy. And December was worse than November. It was worse than October. So of course, people lost even more money as a result. And we are looking at this now. Markets are climbing a little bit higher and they're trying to get back to the levels that they were at in September, or depending on the index itself. But we're looking at this right now being an issue where asynchronous events then lead to a synchronized collapse. I'll show you more in a second here. This is a similar chart, except the S&P 500 in the red, we have the all-country world index excluding the US in the blue. All right, it's basically the same issue. When you see all countries except for the United States, you pretty much get the same picture. You're seeing the events in late January taking place, everything falls, then it's really looking shady for the next couple months, but the US stocks go higher and the rest of the world continues to fall. That was the theme, all right? And it all happened beginning in January, where we had this strange event of the VIX, then some turmoil, but an asynchronous set of events led up to this point when we had the VIX first, then we had the issues with the no buybacks in October, then we had the trade tensions, then we had the quantitative tightening, and the whole bunch of these different things started to pile up, and it brought the markets further and further down. And now for my favorite chart. What you're looking at here is a comparison of the top 4 central banks as well as the stock market. And in this case here, it happens to be the all-country world index. So all stock markets put together, that's the black line. And then the rest of them, you're seeing the Federal Reserve's assets, the ECB, the BOJ, and the BOE, all right? All the central banks together. And what are they doing? My goodness gracious. Yes, in fact, they have been pulling back on their monetary monetary policy. Okay, we call it quantitative tightening, but you can call it printing less money. And in the case of the Federal Reserve, they started to wind down their balance sheet just barely, but it's happening. And you could see other central banks as well, they're doing this, and it happens to correlate and coincide with the worst year since the financial crisis. Could it be a coincidence? My goodness me, maybe it is. Well, I for one have outgrown fairy tales, but hey, if you want to, just turn on your television and they got a lot of fairy tales on there. Bloomberg, CNBC, CNN, whatever, it's all the same garbage. You're looking at this and it is the truth. You can't deny this chart. There's a lot of individuals out there consistently criticizing me on a daily basis, but this right here is my number one focus. I'm looking at what the central banks are doing. Yes, of course, we have other issues with the central banks. They are engaging in manipulation of the interest rates as well, but basically the Federal Reserve, the ECB, and the rest of them are moving the markets. You got to figure out what they're doing and you'll know what's going to happen with the stock market. I have said repeatedly over and over and over again what's going to happen. Not because I'm able to predict it, I'm an oracle. I basically said they're pushing up stock markets with the quantitative easing. If they decide to stop printing money, the stock markets are going to fall. Does that mean I'm predicting it? Well, not really. That's not so much of a prediction. Predictions are when people say on this day, or if the S&P gets to this point, the stock market is going to fall. It's going to fall by 56%. The Dow Jones is going to hit this level and that level and all this sort of business. I don't do that. I never do that. I don't do timing. I don't do numbers. It's just the way it is. You can't predict all that stuff. But if you look at the people who are constantly criticizing me, they're telling me this business. The Dow Jones is going to hit 30,000 by this date. The S&P is going to hit this level by this date. You know nothing. Well, apparently you know everything. So why are you here? Why are you even commenting here? Are you going to try and teach the audience? Please open up your own channel and educate the public. You'll be doing the public a service. Absolutely. The US is known for breaking records, and we have another one. US corporate debt to the GDP ratio. You're seeing it hit another high. This continues to be a problem in the United States, and every single cycle, actually, it gets worse. So we have surpassed the previous cycle, so it could happen at any moment. We don't know where this all will end up. There's no possible way to determine, but it is a leading indicator of a recession when it peaks out like it is right now. Corporate debt is a problem, not just in the US. We've seen a major issue in China right now, exceeding levels. It's going beyond crazy. There's no possible way that this is going to be fixed. I don't know how they're going to paper over it, but hey, that's where we're at today. So let's move on to the next one. World growth in sync. This is an important chart. So what we're looking at is basically 2007 all the way up to 2017. Okay, we don't have the newest information, which I would love to see, but I can tell you, I fill in the blanks for you. And you're seeing a bunch of different countries in this list. It might be hard to see if the font is too small. US, China, Japan, Germany, UK, France, India, Italy, Brazil, Canada are in this list. Now, what I want to show here is the synchronized fashion in which markets move. Every green square is positive quarter-over-quarter growth. So you're looking at all of these different countries, and over time, they tend to move together. The only oddballs in this case have been China and India, where they have reported consistent year-over-year growth. Apparently, they never slowed down. We know that's complete BS, but here we are anyway, okay? So we're looking at these during the financial crisis, starting 2008, 2009 timeframe, and you're seeing all of these countries, except for those two, falling for a period of time. Depending on the country, it affected them differently, but you see a series of asynchronous events. We had subprime, we had bank failures, we had Northern Rock, we had Lehman Brothers, we had Bear Stearns, we had AIG, we had the car companies, then the list goes on. All these asynchronous events lead to a synchronized collapse. Then we have what happened in 2018. We had the VIX index in January. We had trade issues happening. We had the quantitative tightening. We had central bank issues. We had so many different events that occurred along the way. And so the markets tumbled down. And I believe the most important part, of course, is the quantitative tightening. But essentially, there are, again, asynchronous events causing a synchronized downtrend. You want to look at some of these stocks. Goldman Sachs was down approximately 40%. 30%. We are seeing some of the biggest names, like Facebook was down about 40%, and the rest of the FANGs at one point were all in a bear market. You look at the All Country World Index falling down significantly. The global systemically important banks well into a bear market, and it only had gotten worse and worse and worse. But now today, we see some of those US stocks regaining quite a bit of their losses. They haven't reached their peak. They're not even close in most cases. So we'll see what happens throughout January. If the trade talks, of course, get resolved, we could start to see some positivity in the markets, but the trend is in. We see that with the quantitative tightening. It obviously is the most important factor. That's what I wanted to really present to you today, how these asynchronous events start to combine together to form something very big and very dangerous. Don't go anywhere. Make sure you watch part 2 of this video. I have a lot to cover still. I didn't get to fit it into one. There's so much data, but make sure you watch part 2 because I'm going to bring this all together into one neat package. So click on the link in the description and I'll see you there.